please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning and a very warm welcome to all of you. This is the second edition of the annual Mint Private Equity Conclave. We have an interesting mix of people whom I call the entrepreneurial fund managers. People who broke out from large fund houses, raised their own funds, hired their own teams, invested in companies, and building up the business. Similarly, I also have very smart professionals who are building up the Indian franchisees of large global private equity funds. In my mind, they are not less than any entrepreneurs in their own right. So let's kick this off. I'll begin with you, Renuka. If you were to give me the good, bad, and the ugly, the way you see it, of the Indian opportunity mindset, what would that look like?
Good is that in terms of the total set of opportunities, India provides a very, very large canvas. And the story that all of us here are playing for is, will this economy become a $4 or a $5 trillion economy in the next decade? The other good part, of course, about India is it's not just one sector. It's not driven by some government concession, the whole demographic dividend. There is a wide canvas of opportunities to choose from. So we don't really have to kill each other to be in business. We all have room for ourselves. As far as the bad is concerned, I think valuations have always been a challenge. Why have they been a challenge? Because everyone is playing for growth, and therefore every issuer is looking at how much of the future growth should I get discounted and get paid for today. So how much discipline, how much caution is enough is always a question. It's never enough. The ugly part is, I would say that governance, governance internally, governance externally, entrepreneurs, behaving highly responsibly towards this third-party money, because all of us here invest the money of pension funds abroad, and they are oversensitive. So I would say the ugly part is not to have blowouts, because this country just cannot afford it.
Talking about blowouts, Vishal, we are currently reeling under the big blowout of Nirav Modi, right? And when you speak to your LPs, do they really have concerns in this regard, or are you sort of really doing your job well as a well-informed GP, telling them about the corporate governance standards present in this country? What are your conversations like?
And I agree with Renuka's point. Corporate governance is really important. Actually, it's why I think all of us here do what we do, because our investors, pension funds who are sitting far away, other types of investors don't know India. And I think for private equity as an asset class, being able to work closely with your companies to help ensure that the governance is what it should be, the highest standards, not just in India, but around the world, is what our investors look to us for. Look, scams will happen. Corporate governance issues will happen, not just in India. It happens all over the world.
Could you perhaps give us some sense of the levels of governance, in India vis-a-vis some of these countries and these economies? What are you looking at?
If you look at the industry in general, and if you look at private equity, I think the macro situation really doesn't impact us at all, irrespective of what's happening on the macro in a country. Private equity is basically a micro investor. You go and really identify the entrepreneur that's building a scalable company in a sector that you really like. And then you go in and provide the guide rails for the entrepreneur to scale his or her businesses. If you were to compare countries, it's India, Southeast Asia, Indonesia, Vietnam, Philippines, Malaysia, I would throw in even the developed markets in there. These kinds of corporate governance issues happen everywhere.
I just wanted to say two things. One, the quality of corporate governance, I think, is significantly higher today than it was a couple of decades ago, right? And I think that's a reflection on the quality of the entrepreneur and the Indian entrepreneur who realizes wealth creation from his market cap and not any other forms of wealth creation. But more importantly, you've seen such significant wealth creation and the importance of corporate governance have realized that. And I don't think it's only, your question was about what do LPs think about it. The one thing that's happened recently is a lot of strategic interest in India as well. So a particular example, when we were selling one of our portfolio companies to a European strategic, there was an explicit conversation when they looked at companies both in China and India, and they'd seen tens, if not hundreds. The degree of comfort they had dealing with a company which was backed by private equity was significantly higher than just the entrepreneur. Maybe that's not a fair thing in totality, but in general, a company which is backed by private equity, you see a slightly higher level of governance.
After talking about corporate governance, can you perhaps give us your perspective in terms of what you are looking at?
90% of the capital that we deploy is in situations where we control businesses. So, the onus is on us as we draft sort of frameworks for companies and management to follow. Even when we buy businesses, it's something that we really wrestle with. And Indonesia, for example, for a lot of businesses, there is no requirement to have your accounts audited. So we sort of scratch our heads and say, if you don't get your accounts audited, how do you pay tax? So it's on a notional basis, there is some arrangement. So all this stuff pervades throughout Southeast Asia. So on a relative basis, I think India, I would probably rank India at a 7, and some of the other emerging markets, Asia, at like 4.
You just need to be very stoic and be at that same plane across all the volatility, because for us as investors, there are opportunities across every cycle.
Business is politics and politics is business, largely. We can't sort of disintegrate the two now.
That's correct. I think there's always correlation, and within that correlation, if there are some things at the macro, at the India level, which are going to have an impact, you will find great opportunities to go and invest in pearl companies, as we call them, companies that you've always wanted to invest in.
So you have like some oyster companies or fire companies maybe?
See, there are a couple of things. One is, it is a micro business at the end of the day. So if we look at the 19 years we've been investing, there have been changes at the government level multiple times. And when we try to correlate that with our returns, there's no correlation. If you think about it, there are certain sectors, as Sandeep also alluded to, which do depend on the government. But if you look at where a lot of money has been made in India, it's largely been sectors where return on capital has been good, where over-dependence on the government has not been there. IT services, pharmaceuticals, financial services, consumers and emerging sectors. Right?
Sure.
Right? And so if you think about companies in those sectors, you'll find the pearls there.
Shri, you want to sort of add to that? You are fundraising right now. The questions about stable macro, have they been raised by your LPs? And how are you convincing them?
Over a period of time, we have been in existence for the last 18, 20 years. We've been able to prove that, which government is in place, what macro environment is in place. It's our job. We exist because it's our job to find opportunities no matter what the situation is, to both deploy money and exit from portfolio companies. And there are a lot of sectors which are not really government dependent. In fact, if you look at so much of euphoria on this government that a lot of things will happen in infrastructure, etc., not much of it has happened. We all made some bets, to be honest, on the back of such promise, and none of those transpired to be good bets, at least until now.
You're disappointed.
Disappointed to some extent. But on the overall basis, overall, I think my comment is the fact that it's our job to find opportunities.
Thank you. Can you please hear it out for this panel for being so candid? Hello, and a very warm welcome to all of you. First of all, congratulations on the Fortis deal. We really have to give it to you for being sticking at it. Can you perhaps tell us that, how frustrating it is from a fund manager's point of view if deals take so long for fruition? What were the things going on in your mind? How do you really sort of stick at it?
So I think, the important thing here is, one, you have to be slightly ahead of the curve and almost anticipate how things are going to break in your favor. So I guess about 18 months ago, we realized that, if you have a combination, and it's a pretty toxic cocktail, that you had, the Daiichi litigation, combined with the fact that it was almost common knowledge that the brothers had pledged almost their entire equity with the lenders, and that the financial duress was eventually actually going to, overwhelm them. So before, I think a few months before the deal actually became tangible or even real, we thought it was worth having a conversation. So it wasn't a fireside chat like we're having now, but I reached out and, we spent some time. And I think in India, what you realize over a period of time is that, the founders or entrepreneurs or promoters, as you may call them, like to do business with people that they like, right? So you have to earn the trust and, build a relationship before you get to your point in the cycle to be able to strike something. So anyway, all that, took multiple months, and the deal obviously went through various twists and turns, and there were a lot of extraneous issues, a lot of moving parts, and that's still not settled. You still have to jump through multiple hoops to try to get this deal to the finish line, but at least it's the first big milestone that at least you got the blessing of the board and the counterparties now.
So can you tell me one thing, that what was that you sort of kept at it? that this deal, that you will not let go of it? Were you like so compelled by the opportunity, kind of overwhelmed you? For instance, you were also involved in a very long transaction with ICICI Home Finance that not really sort of materialize, right? So was it that you have to get this done anyhow?
I think there are two models, very simplistically. Either you can bid for deals that come in the auction. You could be the highest bidder. The sellers couldn't care less whether it's X or Y who eventually prevails, as long as you're paying the top dollar valuation. Or the other is that you go in the hunt. So I call my business, or our business really, as being elephant hunters. So you identify either a macro theme, or you identify a special situation or an opportunity ahead of its time, right? So you then start positioning yourself ahead of the curve, and then you wait patiently for things to break in your favor. We certainly have the choice of pulling the trigger on auctions, and we certainly look at everything that's interesting. But as we keep reminding ourselves, I think the LPs, our investors, are cycle agnostic. They don't care whether Modi's in power or there's a coalition running the country, whether the broad markets are up 50% or down 60%. They want us to deliver a 20% plus IRR year in, year out. And hence, you have to then be very selective and fine-tune the deal situations that you're going to lean into, because that's your threshold.
Thank you so much, Puneet, for such insightful conversation.
Good afternoon, everyone. The topic we're going to discuss today is trends in the buyout and control deal space in India. The panel here, the funds represented on the panel here have had very good outcomes in strategies, across strategies. Shashank, can I ask you to set for us a quick baseline for why you think control transactions are more desirable, laying out some of the positives and some of the challenges of the space?
Sure, Rashmi. I think on the negative side, not to be ignored, are some of the challenges of actually operating businesses on the ground in India. I'd call it the rough and tumble of doing business in India. Now, we all heard from Puneet Bhatia just before this, and he's embarked on a pretty significant challenge with the takeover of Fortis Hospitals. And as far as the private equity industry is concerned, the question is, do we, as an industry, understand how to operate businesses like promoters do? There are some practices that we can learn from them. There are some practices we obviously have to do differently. Having said all of that, I think your statistic of the increasing proportion of buyouts, and actually my sense is it will continue to grow and grow much higher than the 20-25% that of the market today. But that in itself sort of tells a story, right? Which is where the industry is heading and kind of where returns are obviously heading.
Yeah. What do you think, in your experience, having executed various strategies, what are some of the drivers that are driving sort of the growth and control transactions specifically?
The biggest inhibitor for control transactions to be much larger than what they are even today would just be availability of leverage. So today, I think control transactions have got a lot of traction in sectors which are either dollar-based, like IT services, or to some extent pharma, or there are offshore vehicles where you can actually take leverage, and that allows control transactions to work. I think domestic, the lack of availability of leverage and the maturity of the bond markets, for example, is a big issue in terms of getting control transactions done. Having said that, I think there's clear trend towards increasing control transactions because many businesses in India have gone through second generation, third generation change. It's not been a very easy last 10 years navigating out of the GFC. A lot of people have sort of given up hope, if you will, and said, look, okay, if I can't manage it, let's just find a way to monetize it or focus on core assets. The number of acquisitions, the whole trend around going out and buying a lot of businesses sort of played out. Some have worked, some have not. There are, of course, challenges of actually running businesses. India is not an easy market, regulatory challenge. Plus the entrepreneurial ability kind of gets a little bit lost if you're just replacing the promoter with the professional management team. So you have to find ways to actually manage both those things.
Okay, what about your sector? Because you represent, a unique sector here focused on infrastructure and real estate.
There are a couple of differences, right? Sanjay just mentioned leverage. The kind of money that infrastructure investors deploy is boatloads of capital at lower return expectation. The idea is to generate yield over a longer period of time and not to necessarily buy, improve, and flip out in a 3 to 5 year time frame. So, so the need for leverage to buy control is not there. The second distinction is inheriting existing management or inheriting legacy, as Shashank pointed out. In infrastructure and real estate, you can execute on control transactions in a very different way, which is what we call either a roll-up strategy or a build-out strategy, where you essentially just buy assets. You're not inheriting a management team. You pull together a management team from an infrastructure and real estate standpoint. It's probably played in a different way. The game of control is played in a different way.
Just moving on to the issue of which sectors lend themselves better or more easily to control deals. I think everyone here has done a lot of work in FMCG, IT, so on and so forth. Sahil, do you want to jump in on what your experience has been?
So as an overarching theme, I think we typically would only want to do deals in sectors where there's sectoral tailwinds. If there's a sectoral headwind, it just makes that work that much harder to generate the returns in that period of time we are looking to generate returns. So once an opportunity comes within the focus sectors where we fundamentally believe we want to go after, where there are tailwinds, from our perspective, the way we would look at control deals then across those sectors is which is the business where we can apply our control playbook to. And the playbook has many elements to it, which could have elements such as, can we bring in a really strong management team to drive the business and take over the operations from a promoter? Because we as a private equity firm don't really run companies, and we don't have the expertise as investors necessarily or as deal professionals to go in and run companies. So where can we get the right management? So we focus a lot on value creation elements within control deals, be it procurement, supply chain optimization to reduce inventory and improve on-time OTIF performance, go-to-market efficiencies, how can we enhance either reach, extraction, other opportunities to consolidate the industry, because as Shashank was saying, capital is not really a constraint anymore. So as long as many of these elements check the box, we as an organization tend to be more sector agnostic to the extent, again, that the overarching theme of sectoral tailwinds tend to apply.
Rakesh, what has your experience been? I mean, you've, in your previous organization, focused on a certain sector and also helped build companies in very nascent sectors. Right. How did the control and buyout experience play out where large businesses don't necessarily exist in certain sectors?
So I think, if you look at our experience has been in sectors where, that sector did not exist in the first place. So you have an advantage of creating your own playbook, in terms of how you want to do it. And the advantage of that is that you can find a good management team, you can decide in terms of your capital exposure, and somewhere if your horizon is long term, you can plan your exits rightfully. But the big challenge, if you see, our experience in China has been really good, where you can acquire large tracts of land and you can build businesses and find buyers for your assets. But if you look at India, where if you have to set up a plant, the kind of running around that you need to do, the kind of quick money that you need to pay, and being a fund, obviously you can't do all of that, and that's where the challenge comes. So you need to, there are experiences that is happening. But the new trend that I see, and I think just before our session, when Puneet was here and we're talking about Manipal acquiring Fortis, I think that's the new trend, where you will see a lot of consolidation that's going to happen in operating businesses and companies, and where various PE funds or large global funds can play a huge role.
Keeping on the theme of exits, Nishant, you've obviously been very busy in the distressed space recently. Have you seen private equity interest in that space, and any specific sectors which are driving private equity interest in distressed in a control or buyout situation?
I think when you're talking about distress-led M&A, typically we've seen the private equity industry partner up with strategic players. And I think that's primarily because of the because of the context in which some of these deals are happening and the framework that's available under the law to take over some of these assets. The supply of assets is driven by where the distress is, frankly. And you see that in infrastructure, energy, real estate, and to a certain extent manufacturing, right? These are very promoter intensive sort of sectors where you have a family or an individual having set up the business and having controlled it over a long period of time. And I think, therefore, perhaps there's much more of a need for private equity players to partner up with the folks who can run that business from day one. Again, the framework is such that there's a clean break. The promoters are not allowed to bid for their businesses, and the strategic players wouldn't want the promoters to hang around once the asset has been bought over.
Thank you for the interesting discussion to the panelists, and thank you to all of you.